Hi there everyone, good evening and welcome to a very special episode of The Money Show where we have Nilesh Shah with us in our studios to help you out with your queries on mutual funds. I'm Avand Bash and with me is Avni Raja. Well, we've got lots lined up over the next 30 minutes, so let's not waste any time and bring on board the man of the moment himself. And Nilesh, we were chatting just a short while ago and you were likening the market to the cricket pitch, talking about how this time it's going to be like South Africa's versus last year what we saw, which was India's pitch. So what really is the road ahead for the equity markets? What kind of batting and bowling can we expect?
So as I mentioned, FY 2018 was a Indian cricket pitch. Anyone could have gone and scored run. In test match also you could have played like T20 and you would have scored run. FY 2019 is likely to be South African cricket pitch. In T20 also you'll have to play with the dedication of test match. You'll have to save your wicket so that when opportunity comes you can score run. On the bottom side, the downside of the market is protected because companies are doing well, results are coming good, monsoon is expected to be better, interest rates have come down in last 30 days. The upside is capped primarily because oil prices have moved up, the tariff for fresh salvo is being fired, and more importantly at some point of time markets will start discounting what will be the shape of the political contours in 2019. So we are likely to see a seesaw kind of movement in the markets, going up, going down, and we'll have to really wait patiently and with discipline to make money in this market.
Right. So, Nilesh, like you mentioned, I mean, this is not as easy as it was last year, perhaps, for investors to make money. It's going to be that much of a challenge this year, going forward now especially. And add to that, you have the addition of the long-term capital gains tax for mutual fund investors, equity investors. You have the dividend distribution tax. Given all of this, one, as an investor, one really has to adjust one's returns expectations. What advice would you give investors keeping all of this in mind?
Avni, you have hit the nail. People will have to moderate their return expectation. Last year, you could have hit a Yorker for a 4 or a 6. This year, even half volley will require application to hit for a 4 and a 6. So it will be important to moderate return expectations compared to last year. The returns will be there provided you are disciplined and provided you can stay invested for a longer period of time. The returns will be there with volatility and hence asset allocation will become critical. Please don't invest in this equity market more than what you can afford. Don't look at the past performance and invest. Don't look at the balance fund dividend track record and invest. Stay invested because you have a long-term objective. Stay invested because you can take volatility by your stride.
Okay, Nilesh, I don't want to waste any time. Our phones are buzzing away already with live callers. But first, let's take on board Deepak's query. He says, my son is 5 years old. I want to invest for his future over the next 25 years and build a corpus for his marriage and education. I have investments currently in mutual funds. What other revenues can I look at for, avenues rather, can I look at for investing, for saving for my son? Can you advise? What exactly would you tell him?
Deepak, one, you are a caring father. You are planning for your kids' education as well as marriage 25 years down the line. That qualifies complement as well as your objective is long-term investment. You have started investing in select mutual funds. I hope you are investing via systematic investment plan, which means you are putting some money every month. Second, you have invested in equity mutual funds, some large cap, some mid cap, some small cap, some multi cap. You haven't invested in debt mutual fund because for 25 years horizon, you don't invest in debt mutual fund. The other important point which you need to remember is that your SIP amount should grow along with increase in your savings or increase in your income. For example, you started with the 5,000 rupee monthly SIP in FY 2018. In FY 2019, target 6,000 rupees. In FY 2020, target 7,000 rupees. As the income grows, as the savings grows, your SIP amount should grow. And I'm sure 25 years down the line, your kid will thank you for the wise investments you have done for them.
All right, well, hope that answers your query. Let's get to our live caller who's calling us. Rajgopal calling us from Chennai. Hi, Rajgopal, thanks for calling us. Go ahead, what's your query for Nilesh?
Good evening, I'm an avid watcher of your show actually. I have two queries. One about my strategy and one about my processing query actually. See, I have come out from a major illness and I am lucky to have to receive from my family 20 lakhs as a one-time money actually. And I have a commitment of 10 lakhs in another 2 years, but this 20 lakhs I don't need for another 5 years. So what I'm thinking to invest in a balance fund and a small cap and a large cap fund. And after 2 years, I will pull out the gains and the balance. I can take a loan. If this strategy is right, my second query is if this strategy is right and if I have to take a loan, what is the loan process? I am reading that the loan for against the mutual fund units will be given only for 1 year. Is it right? And how much percentage normally they will give? Thanks.
All right. Thank you for your query. Nilesh, how would you like to help him out?
Rajgopal, if you have a obligation at the end of 2 years, then it's far better to be settled out of your money than taking a loan, because we don't know what will happen after 2 years. My recommendation will be to put the money which you require for 2 years into either a credit opportunity fund or a hybrid fund like monthly income plan, equity saving schemes, or a balance advantage fund, which has marginal equity exposure and which over a period of 2 years can deliver returns with reasonable surety so that you can pay off your obligation. Do we need to take a loan at the end of second year? That will depend upon that time's market. If markets are in panic because of some reaction, some event, then maybe it's important to borrow the money and pay the obligations and continue investments for a while. But today you should invest into credit opportunity funds to balance advantage fund risk spectrum for your 2-year horizon investment. For the rest of the money which is for 5-year horizon, you can look at some sort of systematic transfer plan to invest into equity funds, some large cap fund, some multi-cap fund, and small allocation depending upon your risk profile into small and multi-cap fund. The crucial thing here you need to remember is that every time in 2004 as well as 2009 as well as 2014, elections played an important role onto the performance of equity market. So keep provision for something when markets start discounting 2019 election. Subject to that, you can do systematic transfer plan in a large cap fund, multi-cap fund, mid-cap fund.
Okay, hope you've taken note, Rajgopal, of the advice given by Nilesh. Next up, Tara has reached out to us. She says, I'm employed in the private sector, but I have zero investments currently. Not in equities, mutual funds, life insurance, real estate. But I want to change that. I plan to invest 50,000 rupees a month. What are the top 3 products that you recommend? Can you suggest SIPs or mutual funds to invest in to look at, since she's a first-time investor? Also, she asked, should I invest in LIC or NPS? What would you advise? A lot of people out there really need to take the plunge into starting to invest. What advice would you have for Tara?
So Tara, one, congratulations that you have waken up. Till now you have followed in the philosophy that income minus expenses is savings. But here onwards, please follow the philosophy income minus savings is expenses. 50,000 a month is a reasonable target, and you should start investing definitely that money. Your question is about insurance, NPS or mutual funds. Now insurance, be it term life insurance or health insurance, is necessary. They are for all those unforeseen circumstances which we can't envisage today. So please consult an advisor to take appropriate term life cover, accident insurance cover, as well as health insurance cover, so that you are taken care of any uncertainty. NPS is a very low cost option, but it will provide a restricted equity participation with a cap of 50%. So to the extent of your tax benefits, do invest into NPS, and remember that it's a hybrid scheme rather than full equity scheme. The balance money, which after paying for insurance premium and NPS allocation, you can invest into select equity mutual funds, some allocation towards large cap funds, some allocation towards multi-cap funds, some allocation towards small and mid-cap funds, and try to make these investments via systematic investment plan. And most importantly, you have today decided to start with 50,000 rupee, next year raise the target to 55,000, and year after that raise that target to maybe 60 or 65,000. Don't get stuck at 50,000, and hopefully maybe over 15-20 years down the line, you will thank me for the advice I have given to you.
All right. Well, Nilesh, I'm sure Tara is going to definitely thank you for this advice. Let's go across. We've got another live caller. Senthil Kumar is on the phone line. Hi, Senthil Kumar. Go ahead. What's your question for Nilesh?
Good evening, Nilesh. I'm a long-term investor, saving for my child and child's education and marriage. Basically, the question I want to ask is, I'm looking at such a long perspective. I have mutual funds portfolios on, which is SIPs are going on. So what I do is, if I have some extra cash at the end of the month, and there is a market dip, I try to invest it in mutual funds or index funds. But I'm not sure whether I should go for a multi-cap fund or I should invest in an index fund, because my perspective is about 20 years. What would be your advice?
Senthil, partly I have a selfish interest in recommending you active mutual funds rather than index fund, because I myself manage those kind of funds. So keeping my selfish interest aside, you must remember that at least for some time to come, the actively managed funds will continue to outperform indices. That will come more in multi-cap fund and small and mid-cap fund rather than in large cap fund. So maybe some portion of your allocation you could put towards multi-cap fund and small and mid-cap fund. Obviously, they will be little more volatile compared to large cap fund, but since your time horizon is 20 years and you are investing via systematic investment plan, that will give you great averaging opportunity. The allocation which you want to make towards large cap fund, you can target towards indexes fund. Anyway, today majority of indices funds are large cap oriented. So you can make a division, large cap allocation towards index funds, which will be low cost, and the balance allocation in multi-cap fund and small and mid-cap fund, which will give you better return, better alpha over a period of time. And obviously, you need to monitor this over 3-year, 5-year horizon, whether the funds which you have invested are still outperforming their indices or not. The day they start underperforming their indices for some period of time, then it's time to shift into index funds.
Okay, so even monitoring your funds is fairly crucial. Thanks, Nilesh, for that advice. And we're trying to answer all of your queries as best we can. We've got a ton of email queries. We've got a backlog of callers as well on the phone line. So let's patch it through to Pune, where Prakash is on the phone line with us. Welcome to the show, Prakash. What's your query?
Thank you. Good evening, Mr. Nilesh. I have a question and opinion from you. I seek opinion from you. You are running a fund house, and against the backdrop of this LTCG and the new tax rules, do you think that this is the time for fund of funds, equity fund of funds, where we don't have to monitor the fund performances, and you, fund manager himself manages or monitors the funds and changes the funds, and at the end of more than 3-year period, we pay 20% with indexation benefit. So do you think this will be comparable to 10% LTCG with additional benefit of monitoring and changing and frequently changing the mutual fund schemes? Thank you.
Prakash, your point is absolutely valid. In the past, fund of fund didn't take off simply because of the taxation disadvantage. Now, with the taxation coming through and the gap narrowing, a time will come when more fund of funds will be launched, and they will be investing into different categories. There will be one fund of fund which will be pure equity oriented, which will allocate its allocation between large cap fund, sectoral fund, multi-cap fund, and we will take the decisions on behalf of our investors. Some will be hybrid oriented, which will invest into equity funds as well as fixed income funds, and some will be fixed income oriented, which will take duration call. Clearly, this kind of funds idea has come. It's just question of 6 to 12 months by when such kind of products will be launched.
All right, well, Prakash, hope that answers your question. Thank you for calling in. On that note, we'll slip into a quick break, but we'll continue our conversation with Nilesh Shah. Lots more to talk about, lots of your queries to be answered, and we promise we'll try and take as many of them as possible. If you have a question, number is flashing on your screen. Slip into a quick break, back in a bit. Welcome back. You're watching The Money Show, and we're in conversation with Nilesh Shah, who's answering all of your personal finance and investment strategy related queries. Nilesh, let's get to our next query coming in from Kavita, who says, I'm a 44-year-old housewife with a moderate risk appetite. I invest via SIPs and I have another 15 lakh lump sum which I want to invest. Please advise the best investment option for a long-term wealth creation, and how can I create a balanced portfolio for my savings to work for me in the long term? Nilesh, what would be your advice for her?
Again, Kavita, I hope this 15 lakh came sudden to you, and it was not what you accumulated over a period of time, because otherwise it's suboptimally invested. Now clearly you have to define your asset allocation, what kind of risk you can take. Certainly you want to invest for longer term, but what kind of volatility you can bear. Once you define that risk allocation, you can start investing via systematic transfer plan, which means divide this 15 lakh over next 13-14 months. I'm intentionally trying to cross May 2019, by when general elections will be over, and whatever the impact of election on market will be factored in. And that money you could start investing into some large cap funds, some mid cap funds, some multi cap funds. But most importantly, it's important for you to determine your risk return profile. The second option which I will like to recommend, just from an example point of view, let's invest into balance advantage fund to begin with when markets are at current level. If market goes down, then you can shift from balance advantage fund into balance fund, which will give you 70% equity exposure. If market goes further down, you can transfer from balance fund to large cap fund, which will give you 100% equity exposure. So that's one way of doing investment if you don't want to prefer systematic transfer plan. So either you go systematic transfer plan into large mid multi-cap fund, or you enter yourself via hybrid to balance fund to equity fund in case there is a market correction. Combination of this will give you ideal opportunity in this volatile time.
All right, let's go on board to our next query then. And you know, it's a young student who's reached out to us, Nilesh, Karan Chavan. He says, I save about 70,000 rupees currently in fixed deposits, but I want to switch to mutual funds or the stock markets, but understand which would be better for me to do. So what would you advise someone who's taking the plunge at such a young age to start investing? He wants to make a switch from the conservative FDs into equities or mutual funds. What should he do?
So Karan, the most important thing before you start investing directly in equities is to get the expertise, get the knowledge, get the skill to invest. You have to read balance sheets, you have to go through company website, see what the management's quarterly results and commentary are. And based on that, if you can find out a trend in which you can invest directly, that's fine. Maybe you will make mistakes, but you will learn from those mistakes. One more thing is that don't put all the money in one stock, even if you are comfortable about it, even if you are confident about it. This is the age to get experience. So do diversification in 5 or 10 stocks, which you can read directly, research directly. And if you don't want to do that, then only come via mutual fund.
All right, well, we've got another caller calling us. Vinay Bhasin from Delhi is on the line. Hi, Vinay. Thanks for calling. Go ahead. What's your question for Nilesh?
Okay, I want to call Mr. Nilesh. I have invested in Tata Balance Fund. Lump sum is also there, and also I've got an SIP going. Should I continue with that? What is the situation with Tata Balance Fund?
All right, Vinay, Nilesh will not be able to answer specific fund-related questions. If you have a longer-term investment strategy that you want his advice on, you can certainly ask him.
Or maybe, you know, Nilesh, just tell us the type of funds that one could look at in terms of what are the types of mutual funds one could invest
So
in?
Vinay, the only value add I can give is that, God forbid, if tomorrow there is a correction, then don't stay in balanced fund. At cheaper valuation, a lower level of Sensex or Nifty, you must try to shift into large cap equity fund, so that instead of 70% equity exposure, you get exposure to 100% equity. If you follow that strategy, subject to the taxation liability, I think that will create better return on your portfolio.
Okay, I hope you've taken note of that advice, Vinay. We couldn't directly answer your query, but Nilesh gave you his valuable input nonetheless. Okay, the phone lines are buzzing. NC Roy is connecting with us. Hi there, Mr. Roy. What's your question for Nilesh Shah on mutual funds?
Actually, I am 65 years. Actually, I like to invest 8 lakhs within a week. And I like to be aggressive investment for 5 years. Aggressive for 5 years. Actually, I request Minister to address me in the matter. I like to take risk-oriented scheme.
Did you understand his question, Nilesh?
I had limited hearing.
Yeah.
But what I understood, Mr. Roy, is that you want to invest for 5-year horizon and you want to make aggressive investment even though you are 65 years of age. Now, Mr. Roy, first, at 65 years of age, you need to be securing yourself, and I presume you have secured yourself through some other alternatives. Maybe your kids are taking care of you, maybe you have some other investment. So you are not worried about day-to-day maintenance from this investment. Only on that condition you should be aggressive. Number two, if you have a 5-year horizon, that's a reasonable long-term horizon, and hence you should invest your money either in a systematic transfer plan. So over next 13 months, you try to invest every month some amount of money in a large cap fund, mid cap fund, or a multi cap fund. Or you follow a different strategy where you invest depending upon your risk profile into, and since you said you are aggressive, let's say you invest into balance fund today, which is 70% equity exposure. If market continues to go up, great, that 70% will give you good return. If market corrects, then please shift from balance fund into large cap fund, which will give you 100% equity exposure. And God forbid, if market corrects even more, then shift from large cap into mid cap fund, which will give you high beta exposure. Combination of this systematic transfer plan or shifting at appropriate level of valuation into higher risk product will deliver you better return.
Okay, let's squeeze in our last query for the day. Shishir says, I would like to understand the impact of a structural bull market in bonds on equity returns. If a bond yield goes up 0.75% per year every year for the next 20 years, can equity markets give positive real returns? Nilesh.
Shishir, it's a very tough question because clearly the theoretical answer is that if interest rates continue to go up and up and up in real sense, then the equity returns will start coming down. But interest rates are cyclical. They cannot continue to move in one direction because at every level there will be reaction. So my guess is that over 20 years, I cannot take the call that interest rates will continue to move only upwards, both in nominal and real terms. My bet will be that interest rates will be cyclical. They will come down, they'll go up, and over that sentiment, over that cycle, equities will deliver positive real returns.
Okay, Nilesh, it's been lovely having you with us in our studios, and I'm hoping that we can have you on board with us on the Money Show very often as well. Thanks to all of our viewers as well for connecting with us. I just want to tell you guys that we're going live on Facebook in another 5 minutes or so with Nilesh Shah. So if you have any questions that couldn't be answered right now, you can send them online. Thank you so much again, Nilesh, for joining us.